The best way to live in some of the most expensive cities such as New York, LA, Miami, or whatever city that you choose is to use a FHA loan. And in this video, I will be giving 2 examples of how you can get this done and potentially pay less than everyone else that lives in the city, or how you can make a profit for living in a city of your choice. Let's get into it. Now, let's say for the first example that you decide to move to a very, very expensive city. And you already know a $500,000 home, 9 times out of 10, it's gonna cost you around $3,000 to $4,000 a month, definitely depending on the interest rate. And let's say that you know that's a lot of money that I will have to be paying up front myself. So we're gonna take that same $500,000 example and we're gonna break it down, and I'm gonna show you how you could potentially be living in that property for a small amount out of pocket. So we already know the purchase price for that property is $500,000. When you're using an FHA loan, you're only required to put down 3.5%. So if you put down 3.5% of 500,000, your down payment will be 17,500 as a down payment. So all you have to do is subtract that amount from your purchase price, and then your loan amount would actually be $485,500, and you will be paying that over the next 30 years. Let's say that's what you agree to for the next 30 years, and it's a fixed rate mortgage. Now, over the years, the interest rates have definitely gone up. And so what I'm gonna say is, hey, that the interest rate is 7.1%. Man, I know that's high, but that's just where it's at currently. That would create a mortgage amount of $3,259 per month. So every single month, if you don't use the house hacking method, you will be paying over $3,000 to live in the property. Property taxes are going to be $395 per month. Your insurance will be around $150 per month. And your repairs on the property will be around $110 per month. And when I say repairs, I'm not saying that every single month you're going to have repairs that's needed in the property. No, you're just going to put that money to the side for just in case. If you're going to be a landlord, it's very, very important that you do that. So whenever issues do come about, you will have the reserves put to the side that you can pull from whenever you have issues. So now you see your total expense on this particular property will be $3,914 per month. Man, that is super expensive. But you won't have to pay all that. Let's say that this particular property is a single family home and you decide that, hey, I want to live in a nice area, but I'm willing to live with roommates. So what you could potentially do, instead of paying that $3,000 per month, let's say that you have a 3-bedroom, you can actually rent out 2 of the bedrooms and you have 1 of them. And let's say that you rent out the bedrooms for $1,500 a piece. So basically, you'll be getting paid $3,000 from renting out the rooms. And guess what? That pretty much covers most of your mortgage. So what we'll do is we're gonna subtract the rent from the expenses. So we're gonna subtract $3,000 per month from that amount. And you will be left with an out-of-pocket cost of $914. And this is something that you could potentially keep repeating. Now, with the FHA loan, of course, you have to live in the property at least a year. But you may say, hey, what I'm gonna do, I'm gonna move out this particular room and I'm gonna move somebody else in the room that I'm in, and I'm gonna rent that out for $1,500 or $1,600. And look, the full mortgage will be covered, and you may be walking away with a little bit of cash in your pocket at the end of the month as well too. And that's not just it. Of course, once you paying down the loan, you're actually creating equity in that particular property. And what you will notice with this particular loan setup, you will be gaining $187 per month towards your equity every single month. So really, if you think about it, you're not even coming out of pocket the $914. If you subtract the $187 from the $914 per month, your out-of-pocket cost is actually $727 per month. That's what you factoring in how much equity you're gaining on a monthly base. Now, if you're getting any value from this video, just take 1 second for me and hit the like button, subscribe, and click the notification bell. And now what we're gonna do, we're gonna get into this second example. Let's say that we move to a small town in South Carolina where you can get that same home that's $500,000, but let's say it's additional bedroom. So let's say it's a 4-bedroom, 3-bath, and it's $500,000. Now, with us going into a cheaper cheaper area and adding on an additional bedroom, guess what? That means you can add an additional roommate or additional tenant in that property with you. So let's run through the numbers real quick again. So let's say you have this particular property in South Carolina and you purchase it for $500,000. You have a 3.5% down payment, which means 3.5% of the $500,000 is $17,500 out of pocket. So it will be the same exact loan amount of $485,500 over a 30-year term, and it's a fixed rate mortgage. And we're going to leave the interest rate the same. We're going to say that the interest rate is 7.1%, and your mortgage amount is still going to be the same as well too. It's going to be $3,259 per month. Property tax is going to remain the same. It's going to be $395 per month. Your insurance is the same, $150 per month. And the repairs, we're still going to put aside the same amount of $110 for repairs. Your total out-of-pocket expenses will be $3,914 per month. But the difference this go around, in order for you to make a profit, is the fact that we add that additional third bedroom. We're going to rent that out for $1,500 as well too. So now you have 3 bedrooms that's renting out for $1,500. So that means your total rent that you collect on this property will be $4,500 per month. So now you will see that we will subtract the $3,914 in expenses from the $4,500 that we collect for rent. And that's going to give you a total of $586 in profit. So yes, you do have 3 roommates that's living in the property with you, but they're paying you $1,500 a month. So what you'll see is that it's going to net you $586 per month. Not only that, you still getting that $187 towards your equity every single month. So if you add the $187 to your profit of $586, you're actually walking away with $773 per month in your pockets if you include the equity. So now I hope you see that these 2 examples are ways that you could potentially make money from living in a reasonable area that's not as expensive, and how if you go to a more expensive city, like I said before, such as New York, Miami, or LA, how you could potentially live in that particular city for 1/3 of the cost. Now let's get into the pros and the cons of using an FHA loan. So the pros of using an FHA loan, of course, you only put 3.5% down. Most loans that you use whenever you get in a mortgage, such as a conventional loan, 9 times out of 10, you're gonna put down at least 10 to 20%. But like I said, with an FHA loan, it only requires a 3.5% down payment, so that is a plus. Another pro with the FHA loan is you're not only able just to use it on a single family home, you can use it on a duplex, triplex, or fourplex. So if you don't want the person to be in the same property as you, you can actually have them right next door to you in a small multi-family unit. And if you want to see where I broke down the example using the FHA loan on a duplex, triplex, or fourplex, please check out this video here, because that goes more into details about it. And those are just some of the pros. Now, there are cons when it comes to FHA loans as well too. The first con is you have to live in the property for at least a year. Last time I checked, that was the rule. Maybe it changed, but that's what I know, that you have to live in it for at least a year before you can move out and move another tenant in. Another con is the amount that you can actually take out for an FHA loan really just depends on the area, which that makes sense, because if you go to a very expensive area, of course, the amount for FHA loan is going to be higher. But if you go into a reasonable average area, of course, it's going to be cheaper than the more expensive areas. But that's just another con that you would have to deal with when dealing with an FHA loan. Now, another con of just this whole process in general is that if you're renting out the rooms in your home, you're going to have to deal with wear and tear. You're going to have to deal with other people living in the property with you. And of course, it's going to be hard on you, because if you see that they're tearing up your property or whatever, you actually getting to see that in real time. So definitely keep those things in mind before you actually make this decision, or check the video out that I mentioned earlier that shows you how to use a FHA loan to purchase a duplex, triplex, or fourplex, and you should be good to go. Thank you for watching, and I'll see you next time.